Everyone's mortgages are increasing. Let's talk about it.
Oh my God. Okay. Oh no. I got an email saying new escrow analysis available for my mortgage. I'm a little bit nervous, so let's open it up together. Send code. Email verification. Documents, I guess. Escrow analysis. Let's see what it says. Projected minimum balance. We're receiving a statement because your escrow account with us. We have safeguards in place to ensure that there is enough money in your account to cover your homeowner's insurance, real estate tax, if applicable. However, charges in your tax and insurance could result in shortage or surplus of your escrow account. Based on our recent analysis, you have a shortage of $1,200 in your escrow account. This shortage likely was caused by changes in your taxes or insurance. A shortage may also result if a full month escrow payment has not been made to your account. See these charges referred to Part 2. Automatically spread the shortage amount over the 12 months for future escrow payments. This will reflect an increase to your monthly mortgage payment. Okay, great. Okay, our mortgage is going up by $200 a month. Mortgage is going up from $2,518, so I think I pay $530 to $2,714. It's going up by $200 a month. And it starts in August, effective in August.
This is happening a lot right now, guys. There is a lot of people who are getting hit with the escrow bug. Basically what happens here is when you have a mortgage, right? Majority of the people who have a mortgage payment, they have also what's called an escrow account. An escrow account is basically where your taxes and your insurance payments get held. So whenever those bills come due, the mortgage company pays that on your behalf with the money that's been put into the escrow account. Now, what happens whenever your insurance goes up next year? Well, your escrow payment has to go up to cover that. So what's happening to a lot of people is they have these fixed rate mortgages, right? And they're like, oh, my payment's working for right now. It's okay, everything's good. And then, God forbid you live in Florida and you get tacked with a new insurance bill next year comes around and you're like, oh my gosh, my insurance has skyrocketed. And now your payment's going up, your mortgage payment's going up by $200, $300, $400, $500 and even more than that in some of these clips we're gonna see. That's a very, very scary thing to have to deal with, especially with what we're living in today's age and the cost of living, because everything else is going up in price too. My question is like, when's the ticking time bomb gonna go off? When is it when it's like, everyone's like, I can't do it anymore. I just literally cannot do it anymore.
This is my monthly mortgage payment as a 32-year-old homeowner living in central Pennsylvania. I bought the house this January of 2025, and the original loan amount was $193,000 even, with a 6.625 interest rate. That hurts my heart, because I don't think that number is going down anytime soon, y'all. Now, $1,061 is what goes to the interest every single month, and only $174 is what's going to the principal balance. Now add in an additional $503.32 every single month for my homeowner's insurance, my flood insurance, and taxes. I also have an additional $46.64 for my mortgage insurance because I did not put 20% down. My total monthly mortgage payment to $1,785.76. I am usually able to put an extra principal payment down every month. Like last month I did $65. The month before that I think I did $50, but I'm also trying to pay off my student loan, so that number can't really go up that much higher. But yes, that is what I owe.
So I'm a mortgage broker, right? I deal with mortgages every single day. Every single day I'm talking to new buyers about the strategies of homeownership and how they can afford their mortgage payments. Now, lenders get paid on the amount of the loan size that is given, right? And I'm probably a little bit different than most because I love personal finance. I love teaching people about money. I'm probably one of the only, well, maybe not the only lender, but I'm probably a little bit of a different type of lender because I'm not chasing the highest loan amount for my buyers. I want my buyers to be able to afford their payment comfortably. And we talk, budget strategies and things to look out for, like escrow accounts going up in the future. Can they handle that if that happens? These are the things your lender should be talking to you about. Because not only that, guys, when you are a homeowner, you have more than just your mortgage payment. It's not like rent. When you're renting a place, you pay your rent and utilities and that's it. If something breaks, the owner fixes it. Well, if you're the owner, guess what? If something breaks, Now you have to fix it. Now, one thing where this really comes into play, guys, is when you do start buying real estate, but not just buying real estate as your personal home, but also as personal investments. Guys, if you're a landlord or a real estate investor trying to grow your portfolio, one of the smartest moves you can make is treating your rental business like a real business. That means getting serious about how you manage your money, and that's where today's sponsor, BaseLane, comes in. BaseLane is an all-in-one smart banking and finance platform built specifically for landlords. It brings together rent collection, bookkeeping, and banking into one powerful dashboard so you can scale faster and stay organized. With AI-powered bookkeeping, it categorizes your transactions automatically and helps you stay tax ready with just a few clicks. You can generate real estate-specific reports like income statements, net cash flow, and even property-level performance with just a click of a button. And for rent collection, it's hands off. You can automate payments, send reminders, charge late fees, and get deposits straight to your account as fast as 2 days. No more chasing tenants or juggling spreadsheets. BaseLane also lets you open unlimited virtual accounts so you can separate funds for each property, reserves, operating expenses, profits, security deposits, you name it. That makes cash management simple and clean. If you guys are serious about growing your rental business, sign up for BaseLane, and when you fund your account, you'll get a $100 cash bonus. Just head over to baselane.com/JJ Buckner. I'll have a link down below in the description and a pinned comment as well.
Did you know that mortgage literally means a death pledge? Like in French, I think that's how you translate the word mortgage, meaning that the deal dies when the debt is fully paid off. I need them to rename that expeditiously, because why did y'all just increase my mortgage by $500? Take the mort out, because it's not giving that this deal is dying anytime soon. Take the mort out. Add viva la edge. The only time this deal is dying, apparently, is when I do. It was never giving mort. It's giving living. And another thing, I want to be included in the rent is too damn high narrative now, okay? I want to be a part of that narrative. Why are y'all trying to be exclusive of those of us that sip the damn Kool-Aid that we should buy a house? Mortgage is too damn high too. Why am I paying this much to exist, to live, to be housed? Nobody asked y'all to start building houses. We could all be out here frolicking in the streets, lollygagging outside. We could be, but y'all decided to do all this, and then now I have to pay for it.
So inventory, I've noticed, is picking back up a little bit, but again, this is for my market in Missouri. I don't know how other people's markets are out there that are watching, but for the housing market, just to kind of go off what she was saying with how everything is just sky high, super expensive, and that is still the case. Everything, yes, is still expensive. What I'm noticing though is that we are starting to see a bit of increase in supply on the market. So inventory is picking up. So more homes are sitting on the market for longer. And what we're seeing is the sellers, a lot of them are still thinking it's 2021, 2022, where homes were, sky high rocket price and they were, flying off the shelves left and right. But that's just simply not the case. Buyers are sitting on the sidelines longer. They're still waiting for rates to come down. Or we're also noticing that they are just very, very cautious. They are cautious about inspections. Appraisals are also starting to come in low. So that makes me wonder what's happening with the market. I think right now we're at just like a standstill. And I think we're at a standstill until one, rates come back down, or two, more sellers start to realize, hey, we're gonna knock prices down a little bit to just get in line with the market. Now, as soon as rates come down, that's where I think we're going to see a skyrocket in the real estate market again. Now, when is that going to happen? I don't know. Everyone's thinking that in September at the Fed meeting, they're supposedly supposed to be cutting rates. Again, we have no idea. No one has a crystal ball, so we can't tell the future, although I'm hoping that rates do come down. I'm waiting for it. It'd be nice. I'm looking forward to it. The only problem with it though is it could send home prices higher.
About to literally tell you what we spend on a monthly basis as a 25-year-old married couple living in Greenville, South Carolina. First and foremost, this is the worst one every single month. Our mortgage is $3,400. Our power bill is typically around $160. Water bill is around $85 a month. We usually spend around $600 on groceries, $350 on eating out, $250 on gas for our car. Car insurance is $314, Wi-Fi is $60, we pay $38 for pet insurance, $60 for life insurance, and $14 for our gas bill in our house. Month of June so far, we have spent $817 on like miscellaneous things. That includes Amazon, Target, Nuuly, like all the things that are not necessities. We also put a percentage of our paychecks into a savings brokerage account. Both contribute to a 401k. My husband contributes to a Roth IRA, and then we also tithe to our church. So all of our absolute necessary bills add up to a monthly cost of $5,331. So I would love to know what y'all think, if that's high or lower than you expected. I feel like cost of living here is pretty average. It's not high, but it's also not super, super low.
So that's what everyone should be doing, guys. That's why I included this clip in here. I think everyone should know those numbers. Now, I'm not saying you have to know them off the top of your head, but if you just can write them down, analyze them, and understand what you're spending in each category, how much you're spending in those, that is very, very important. Now, looking at her numbers, I would say that's, for today's age, is probably pretty average, right? I think the biggest ticket line item there is the mortgage payment. I think she said it was $3,400. That is, you know, a very, very large percentage of her overall spending that she talked about. They seem like they're doing fine. I mean, they're contributing to their retirement accounts. They're contributing to savings accounts. So they have money left over at the end of the month. So I'm sure they're doing fine. They can afford that. The only thing that I talk about, or that I want to mention whenever you guys are potentially looking for a home, is make sure that you can afford the mortgage payment that you're going to get in. Because what happens in the scenario we've been talking about where your mortgage payment does go up $300, $400, $500 a month because of escrow accounts increasing, because insurances go up or taxes go up. Now, one thing I want to mention here is if it's the insurance bill that goes up, you guys can always shop around for new insurance, right? You can always shop around and get new insurance. I tell my buyers this all the time. Anytime your insurance bill goes up, if let's say 12 months from now it goes up by $2,000 a year, and you know that's going to increase your mortgage payment by another $100 and something, well, then let's look at potentially shopping around for a new insurance agent or a new policy holder. I would maybe think about reaching out to an insurance broker so they can shop multiple different areas for you and let them give you the quotes, and then you can compare that to what you currently have and see if you can get your mortgage payment back down to what it was previously. Now, one thing to look out for with that though is don't let them shop around and make your insurance coverage worse than what you have now. You want to keep the insurance coverages the same, or sometimes people I think are a little over covered. So just some things to talk about. Try and find a trustworthy broker, and I'm sure they'll be more than happy to help you out.
Well, I just received my letter in the mail from my mortgage company for a shortage amount on my escrow, which is awesome. Every year for the past, I don't know, over 6 years, it's been short, but it's been going up and up and up. Last year it was like $1,100 short. This year we're looking at $1,557.56 short. If I don't pay that, my mortgage will go up like $200. Awesome. So luckily, I've learned over the years I need to save up money for this. So I have put away in savings to cover this shortage amount every year. Gotta love owning a home. Anyone else's taxes and insurance gone up like huge this year? Tell me in the comments if yours drastically changed this year.
Now let's end this on a little bit of a funny note, right? Let's think about this for a second. Let's say magically prices start coming back down, or wages increase to keep up with inflation and cost of living, which I'm not sure if that's happening anytime soon. But let's say just, you know, or we happen to go through a recession, which brings prices down, you know, anything, right? My question to you guys is, do you think our taxes on our home and our insurance on our home, the cost-wise, is going to go down with it? Highly doubt it. The moral of the story here, guys, is when you go to buy a home, make sure you're buying a home that you can afford. Generally, people are saying if you can cover 25, or if your mortgage payment makes up around 25 to 30% of your take-home pay, that's relatively, you know, affordable. The problem, though, is with interest rates and also the price of homes where they're at currently, it's very hard for a lot of people to meet that criteria. Very, very hard, especially if you live in a higher cost of living area. It's almost damn near impossible. So right now, I think the best thing is to work on getting our overall finances together, because I'm also a fan of renting, right? If you're in a spot where you're not quite ready to buy a home, I think renting is a great option because it can give you the opportunity to not have to worry and stress about everything else going on in the home. You know what your rent payment is, pay the rent, and then focus on paying off all the other debt you have, so whenever you're going into a home, you have no other payments to worry about. That's the way to do it, guys. Manage your money accordingly and don't go buy a home until you're 100% financially ready for it.